Today, I'm going to be commenting on the performance last week of equity markets and the impact on a typical TPS balanced portfolio. I'll then be reviewing the decision by the ECB in relation to quantitative easing and interest rates, and then our views on European equities and government bonds. Last week, markets continued their good performance. The FTSE 100 was up 2.65%, as well as the S&P 500 and the Dow Jones Index also increased by 2.5%. The oil price has firmed and is trading at a $52 to $53 range since the agreement by OPEC to limit supply, and the US dollar-pound exchange rate has settled at a trading range of 1.24 to 1.25. The positive performance has impacted our portfolios. In a TPS balanced portfolio, it was up 1.7% last week, which means year to date, the performance of a typical TPS balanced portfolio is up 12.9%. Last week saw an important meeting by the ECB where the President and the Council announced that they were extending the quantitative easing program. However, they were changing the actual quantum. Up until the end of March 2017, they will keep purchasing 80 billion euros worth of debt. However, to the end of 2017, they will extend it to buying 60 billion euros of debt. This has had a positive impact in relation to the markets. The President, within his comments of the press conference, was very dovish and said that he would do whatever it would take to support the recovery on the European continent, and markets have reacted positively. Initially, markets believed that this was going to be a tapering and it had a negative impact. However, we believe that in the second half of 2017, the tapering will become an issue which the ECB and markets will have to address. As far as European equities in relation to our portfolios, we have a positive view. We see they have attractive valuations against their peer group, and we see positive earnings growth coming through on the European continent. Therefore, we maintain an overweight position in European equities. This contrasts to our view on government bonds. We maintain a cautious stance on government bonds. While they represent an important diversifier and liquidity within portfolios, given that deflation has come to an end and that we are likely entering into a period of rising interest rates, we do not believe the return expectation is of benefit to our clients within their portfolios. We prefer corporate and investment grade bonds.